Hello, good afternoon. I'm Alex Mozed, and we're here on Winner Take All, where we talk about the back and forth between tech monopolies and incumbent businesses. And how is this story going to play itself out? So for news today, Peloton filed their S1 today about going public. We're going to dive into that. Is Peloton a platform company? Big story in the Wall Street Journal. Amazon's taking down a bunch of products, like 5,000 of them, or 3,000 of them. Is this the end for Amazon? Opentable launches food delivery. Interesting move here, and has partnered with some of the food delivery platforms that everyone is familiar with. Opentable is owned by Booking.com. So let's jump into that. And then take a step back and look overall at what's going on between this common battle between value investors and growth investors. And what does that even mean? But what are kind of the differences in thought process on investment strategy and the next 5 to 10 years? So looking at Peloton at their S1, I was reading through it and I was searching for how many times they used the word platform. It came up 96 times in the S1. And they also use things like social and network and all this kind of stuff. Here, I'll show you. 94 times, sorry. And so it is Peloton a platform company. They say that we are the largest interactive fitness platform in the world with a loyal community of over 1.4 million members. Now, if you don't know what Peloton is, you can basically buy a fitness bike for $2,000 and it has an iPad on it. Now, that would be somewhat, that's overgeneralizing.
Not a very generous interpretation.
Nick Johnson, co-author with me on the book. But it is actually tracking how vigorously you are biking, and it's feeding all of that data into the iPad. You can just download the iPad app and get a membership where now you get access to the content. But the content is linear. Right? And how would you describe it?
My understanding, Peloton basically makes most of that content themselves. They have, backgrounds and things you can bike through.
They have trainers that will have you in live sessions.
Right.
And those trainers are their trainers on their balance sheet.
Right. They basically have a bunch of service providers that they hire and pay for that you get as part of this $2,000 bike service that you purchased.
Plus, I think it's
a subscription fee,
$40 a month as well. $39 a month. It's great. And if you're a digital only subscriber, it's $19.49 a month. And look, the growth for them is amazing. They've basically doubled revenue the past 2 years.
Yep.
They are losing money, but there's huge growth, which clearly, investors in these kinds of businesses highly appreciate. And what the interesting thing is they were saying is that they actually raised the price of the bike, and because their customers are more affluent.
Right.
And so the customers thought the bike was too cheap, and it actually cheapened the product. So they basically just raised the price of the bike, and then the products seemed to be more appropriately targeted or priced for this demographic that they were going after. So that was really interesting.
Good position to be in.
Raise the price, and this seems like a better quality product to me. Okay. But look, all of that said, it seems like a great company. The one platform-ish dynamic that they have is the social networking model where you can have friends and then you can see if other friends are taking classes, and there's a competitive dynamic to see who is exercising more and harder and more aggressively and who is not. But, is that does that make them a social network?
Well, I think we go back and look at, for the Platform Insights product and looking at, is this a platform? Do they make revenue from this? It seems like this is an add-on feature for them. There is no real core transaction that generates revenue here. So if you were to say, would we consider them a platform business? Doesn't sound like it.
Yeah, or they may have a platform dynamic, but it's not a material part of the business.
Right.
Hence, they are a linear sure, technology company with an integrated bike product.
Yep.
Doesn't mean that the company is bad or overpriced. I don't know exactly where they're going to IPO at.
I think you're seeing a lot more of these kinds of smart fitness products taking off and coming out. I think Peloton was one of the early movers, so I expect in the next 3 to 5 years, you're going to start seeing some bigger competition coming in for them, but they've definitely got a good niche that they've narrowed out for themselves, and definitely think there's some opportunity there.
Power to them. Wall Street Journal, look at this cover article. It's taking up my whole iPad screen. I don't know. I find that kind of annoying. And like, it's not even one full iPad screen. It's a scroll and a half. I guess they're trying to emphasize how many fraudulent products Amazon has on its site. But here's the problem. Thousands of products banned. So Wall Street Journal gets published an article saying that they had, I think, 5,000 or 6,000 identified 5,000 or 6,000 products on Amazon that were fraudulent, or the product descriptions weren't accurate, or there's some kind of other issue. Basically, these products were misleading customers.
Right, and I think in some cases breaking laws.
And then Amazon, I think, took down maybe 3,000 or so of them, so maybe 60%. And then this is the follow-up article that says they've ceded control of its site. And just like tech companies are struggle to tackle misinformation on their platforms, Amazon has proven unable or unwilling to effectively police third-party sellers on its site. I mean, this seems a little disingenuous to me.
Yeah, I mean, I think you have to remember the scale that Amazon operates at. It has, like 300 million plus SKUs? Let alone multiple sellers for each of those SKUs. So you're talking about hundreds of millions of sellers, or some sell multiple products. So maybe not quite that, but there's tons of people here operating. Amazon also recently put out its own small business report saying here's all the businesses that have been built on Amazon, and we've been good for small businesses, which in many ways is true.
Yeah.
But I think so. If you think of it in terms of the scale of Amazon, a few thousand products doesn't seem like that big a deal. I think what it does show...
This is like 0.0001%.
Right. But what I'd say it does show is that if I'm looking at Amazon, I don't expect them to self-police this the same way. This is a basically rules and standards, trust and quality issue. Can I trust the products I'm buying on Amazon or not? And so far, Amazon has basically had to self-police this the same way a Facebook or Google has had to self-police, what is fake news? What is good quality content? And in an ideal scenario, it doesn't want to do this, but it seems like it has some legal obligation, or soon will if it doesn't, to do this. So this is the kind of thing where a regulatory body could have a positive impact. If I were to say, where would you look at where it can help impact the consumer experience for Amazon, making sure that these kinds of things don't happen, having some kind of independent review process that isn't just the Wall Street Journal, but someone who's ongoing, focused on this. That could be a positive. But to make this seem like this is, a pervasive issue that means Amazon is, screwed or, up a creek without a paddle and can't figure it out, I think that's a little bit alarmist, kind of clickbaity.
Here's the problem. If you try to regulate this and say, here, consumer protection, you have to have these policies or whatever it is, right? It's going to make it just that much harder for the other up-and-coming marketplace competitors to Amazon,
right,
to compete with Amazon, because Amazon's going to be able to comply with those rules in a bigger and better way than everyone else.
Well, I think you could structure it in a way that it's focused on the too big to fail kind of players. Amazon is so big,
just the modern monopolies.
Amazon is so big, it's systemically important. It can't control all the stuff that it has on its marketplace, so it needs an independent body to help it do that, some kind of review board.
Well, yeah,
or if I'm a startup, then I don't necessarily qualify that the same way. If I'm a small regional bank, I might not qualify as systemically important. So I think there's ways to deal with that. Whether or not I expect it to be dealt with effectively is another question.
Yeah.
But
I mean, end of the day, what happens? I mean, again, this is a little bit different than the B2B distribution industry, where if those products are fraudulent or go wrong, I mean, it could mess up an entire assembly line of products and really have a lot of
also hurt people. in a serious way.
Right. I mean, again, that could be the scenario here, but
Right.
I think most of these you're going to get refunded, and then the seller is going to get banned, or their reputation is going to be severely, negatively impacted on Amazon.
Yeah,
They have procedures in place for this. They're definitely taking off. I guarantee Amazon's taking off millions
of products every day.
Of products, yes, right. Tens of thousands every day, maybe hundreds of thousands every day. That they're already doing this. Wall Street Journal found 5,000 or 6,000. Great. I don't know if you try and create some overbroad marketplace regulation, you're actually just going to make the marketplace landscape less competitive rather than more competitive, which ultimately is hurting the consumer much more in the grand scheme of things.
I think what I would take away from this is Amazon can certainly do better, and there are ways to get there. And it doesn't hurt to have that pointed out, but I don't think this is like a pervasive issue that is the sky is falling.
I'll tell you this: it's not a pervasive issue that should take up a screen and a half on my iPad. That's what I'll tell you. So, Opentable. Opentable's owned by Booking.com. It was acquired for maybe $1 or $2 billion a few years ago. Yep. Not a too material acquisition. But what is interesting is Opentable is definitely the most dominant reservation platform for restaurants in the United States. It's a global company as well. Booking.com owns Priceline.com and a bunch of other businesses that we've talked about. Basically, Booking.com and Expedia are the two large, hotel marketplaces, and they do air flights.
Booking.com
and all these
has
other
a
things.
few of these kind of booking type sites, as well as they've started to do more kind of alternative accommodations. Yep. I would say less strictly Airbnb style, people renting out homes, and more like kind of bed and breakfast, or as I say, non-traditional hotel accommodations. Yeah. That they're using basically is say, oh, hey, we have an Airbnb competitor.
And Booking is in Plaid. So this is what I thought was interesting is you're seeing a convergence in the food industry. You're seeing it American Express by Resy. You're seeing Caviar actually get acquired out of Square. So you're seeing consolidation in the food delivery marketplace space. Now what you're seeing is Opentable come in, the dominant restaurant reservation platform, come in and say, hey, we're going to do food delivery, but we're not going to try and handle, because really the food delivery marketplaces are a three-sided marketplace. I have the customer, the restaurant, and then the third-party courier delivery contractor. And what Opentable is saying, I'm just going to partner with Caviar, Grubhub, and Uber Eats to do all the fulfillment to these stores, and I'm sure help give them the menus and the inventory and all that kind of stuff. But you've gotten all now, I argue, probably the three largest players in food delivery. What Delivery Hero is not here, but the other, three large players agreeing to come onto this, and it just rolled out. And I'm sure there's some rev share and that kind of stuff. But to me, that, this is really the beginning of Opentable getting into, I'd say, a much more holistic offering of going end to end of catering to the restaurant, right? It was, I'm going to help you now bring people into the store, right? Now this is saying, well, I think their example was if it's raining and you don't want to go there, I'm still going to let you now order food from the restaurant.
I definitely see some natural synergy here. If you're saying, I'm going to cancel my reservation because it's raining. It's just one example. Okay, you want to order food, takeout or delivery from there instead. Way for that restaurant to keep that business. From a restaurant's point of view, having all this stuff in one place could definitely be attractive.
Yep. And the interesting thing with Opentable is that the economics of their platform actually aren't that good. I think they would charge at a time they were charging $1 for every person that books, comes to a restaurant. That's changed, but you would think for Opentable, which has, I'd say, such a dominant role in restaurant bookings, that when they were acquired for $1 or $2 billion, it seemed low to me, and I think that just came down to the way the economics and the food industry just has such low margins.
Right.
And so the interesting thing that we see with the food delivery marketplaces is they're actually taking a decent size cut. Definitely north of 10%. From what I've heard, it's around maybe 15%. Could be more in certain cases, which is a much heftier cut of the overall revenue pie.
Right.
And so I think that's one thing that's interesting to Opentable is trying to dip their toe into that arena. What I would not be surprised to see Opentable do next is to say, okay, how could I now do things around point of sale systems?
Mm-hmm.
How could I now go much deeper into the restaurant, essentially kind of entire life cycle of all these different apps and technologies that are coming in? There are some mega restaurant point of sale tech startups. I mean, but these companies are raising mega rounds for restaurant point of sales.
Yeah, I think Opentable has some integrations with these various systems. I think one of the startups that has done very well, Toast, for example, they have a Toast integration. So you can tie back to if you have an existing point of sale system.
Toast has raised $500 million.
Yep.
Point of sale system, linear, SaaS.
Yeah, and the interesting thing about Opentable's business too is about half of the revenue, I think, or somewhere close to that, is SaaS. The other half is basically the transaction revenue from facilitating bookings and then getting basically a lead gen fee for every booking that actually shows up.
Right.
But a lot of that revenue is still basically this booking system that they give to restaurants that you can basically run as kind of your back end system for managing bookings and who goes where and tables and that kind of stuff. And so it's a mix of a business, which is why at their valuation it's not treated as a pure platform business, partly because they have a lot of SaaS revenue.
Right.
But I could see point of sale being an extension of that in terms of the services they offer to restaurants. I think
that's the missing link, because the big challenge is I finish my meal.
Right.
I want to pay. It's actually, there's a lot of friction with that. There's a lot of startups that have tried to solve that. There's like some other startups that have come and gone by now that were trying to just make that seamless, that payment.
Mm-hmm.
And Toast, these companies aren't even really doing that. They're just giving them a better point of sale terminal.
Yep.
And then, they have a mobile thing that they can bring over to the table and you can plug your credit card into it, which Europe had been doing for years before the US. But my prediction would be that now we see Opentable go via booking.com and make a pretty big sized acquisition in the point of sale space. And I think that would be really interesting and really give them a holistic package to the restaurant. Very hard to go head to head with that combination.
Yeah, I think the challenge for them is that, why they never grew beyond where they did. They never really expanded beyond that kind of main core transaction of booking to expand to other stuff related to that. Booking.com bought them because they thought, if people are going and traveling a lot, what else are they doing there? They're making restaurant reservations and booking. There's a lot of overlap between those two user bases. So the synergies there are why they eventually got bought by Booking, which is, of course, expanding into multiple different kind of core transactions and platform types.
Mm-hmm.
But to see Booking basically take Opentable and continue to expand that would help justify that acquisition, I think.
Yep. Agreed. Going back over to the retail side of things. This one's interesting. So Hudson's Bay decides to sell Lord & Taylor for $100 million to clothing rental service Latote. What is this company, Latote? I mean, and this company, Latote, is buying Lord & Taylor? I mean, and they only have 38 stores. Lord & Taylor, just the brand, I don't know, doesn't that just seem so much larger than A, $100 million, and B, 38 stores?
Well, I think it speaks to the struggle that a lot of retailers have been going through, that some of these are really distressed assets, and it's not just the brand that you're buying. You're also taking on, does that company have debt? Does it have underperforming stores? And it's becoming difficult for a lot of retailers to stay cash positive.
Yeah, there's all kinds of weird things with this deal. So the CEO of Hudson's Bay says, we're excited to have reached an agreement with Latote that creates a new model for Lord & Taylor, bringing together fashion rental subscriptions with traditional retail. For HBC, this transaction builds upon our previous bold actions, further enabling us to focus on our greatest opportunity, Saks Fifth Avenue and Hudson's Bay. So Hudson's Bay, it's a public company. They own Saks Fifth Avenue, Hudson's Bay, this other Galleria thing. What's their stock price doing today? Oh, it's up. This is just scary stuff to me. I guess I would be trying to get rid of this thing as well, but Market cap of $2 billion. The stock is basically not moving. I bet they're just losing a bunch of money on this thing. And so it seems like a fire sale. $100 million. You get a brand of Lord & Taylor. It really just does not bode well for the retail industry. I mean, you saw Barney's go bankrupt a few weeks ago. Le Tote has raised $62 million. I don't get it. Where does the $100 million come from? They've only raised $62 million. You know, maybe these guys raised it from their investors, or they got some debt. All kinds of funny business with this. Wow. Shocking. Honestly, it's shocking. And this thing, I don't think it really got a lot of news. Yeah, Le Tote, a rental service founded in 2012, has plans to reinvent Lord & Taylor. Oh, this is going to be good. The customers have spoken, and people are looking for smaller, more personalized locations. That's something we do well at Le Tote. The rental subscription business, this idea that I guess what these guys are saying is that they are a online fashion subscription business delivering rental fashion. Okay, so this thing is basically a Rent the Runway-ish competitor. And Rent the Runway had a lot of issues. Rent the Runway, linear. They'd have all these dresses. And what would happen is the dresses get churned through so much.
Right.
And so, you know, they had all these stocking issues. Dresses would get damaged. You know, they'd have to replace them. And the dresses, after they're worn a few times, would show wear and tear. And then they still need to stock all this inventory of dresses. It, you know, was obviously not a marketplace model. The founders have moved on. One of the founders is now running a division at Walmart, and it's actually their kind of personal concierge service. But Rent the Runway, wow, has raised $540 million. So this business to me, just this renting apparel in a linear fashion, tough business, linear business. This Le Tote thing, buying a retail store, also screams desperation. Screams desperation on the Le Tote side, on the Hudson's Bay side. Let's just get rid of these stores. Yikes. I mean, man, retail's really in trouble. And this is just the tip. And then they say we have a big opportunity with Saks Fifth Avenue. This is really where these public CEOs, they shouldn't be. I mean, I understand that they want to be bullish and they want to give a positive, optimistic tone. But at some point, you got to just wake up and face the music. And I don't want to say that they're misleading investors, but these businesses, I mean, are in a lot of trouble. Yeah. And I mean, it makes sense why they're trading on the OTC market. And it's listed in Canada and all these kinds of things. But yikes. This is scary stuff. It would not be fun to be a retail CEO right now. I can tell you that much. And I think this goes back to this overall conversation. So there's basically two camps of investors. Generally, there's value investors and there's growth investors. Value investors are saying, okay, we are going to look for businesses that the true value is not priced in correctly to the market, right? So what you're saying is, you have a hypothesis about a specific stock or maybe a specific vertical that there's going to be either there's a gross misalignment in their assets. You know, typical examples are like this business actually owns a lot of real estate and they're a retail business, or there's some kind of restaurant business and they own the real estate and the real estate isn't properly priced into the overall stock price.
Trading at a discount basically to their assets.
And this was true of like the oldest activist investor stories of the early 1900s, where they would go to these railroad companies and then these railroad companies would have these massive real estate holdings. And they would say, hey, I mean, like literally, if I look at the valuation of the railroad business and I look at how much real estate you own, those two things are the same. It's not even pricing in the operations and the profit that's coming from your actual railroad business. Hey, company, you should come in and you should sell off your real estate so that, and pay a one-time dividend or something like that to investors, because there's a huge discrepancy in what your company is actually valued at and what the market is pricing it at. Again, I'm overgeneralizing here, but you could generally say that is the value investor theory. It's either on a company level or a sector level that something is not being properly recognized in the public markets. The growth investor model is a little bit different. And what that's saying is that we believe that this company, although it already has very high, say, revenue multiples or PE multiples, right, that they are going to be able to outperform over the future. And that they're going to be able to continue to have growth that is basically not priced into the current stock price. And so naturally, growth companies would resonate with tech companies. And what we've basically seen over the past 10 years is that growth investors have done much better than value investors. Why is that? If you look at FANG, if you look at just a lot of the tech companies, they've been able to continue to outperform. Why is it that many of the world's largest companies, now tech companies, Facebook, Amazon, Microsoft, Apple, Google, Netflix has also done very well, even though it's not a platform. Why is it that these large cap tech companies have been able to continue to outperform and continue to beat earnings? Maybe they miss one earnings here or there every, say, like 20 earnings cycles or something like that. But why is it that this is able to happen? And here's what's going on. Yes, these platform companies are basically massive new business incubation engines. And these platform companies create one dominant platform in, let's say, Google search, right? Let's say Google search creates a dominant platform to connect you to other websites. And now then Google's going to go and have multiple other teams that are then spinning up adjacent platform businesses that can then leverage one or both sides of the existing platform in Google search, or other value add services or just advantages that Google has, given that it has a dominant platform business in search. What would be some examples of this? Let's jump into that.
Well, I think one of the big ones that's been a success for them is Android. So they acquired this, at the time, small company called Android
for $50 million.
And basically that became the today dominant, or along with Apple and iOS, the dominant mobile operating system. And the goal for them was basically, we saw this as a defensive measure. So it's not that I'm Google and I'm going to go charge all these handset makers for Android and make tons of money that way. I'm going to give this away for free. And what it does is basically provide me with a avenue to put all my Google products, so things like Google search, on a phone without having to pay for access. So if you look at what Google does on the iPhone, they pay Apple a huge sum of money to be basically the default search engine, or one of the default search engines.
It's at least $1 billion a year
available on the iPhone. So the thinking from Google's point of view is, if I create this platform, it helps me defend search because I don't have to pay to get access to all these customers.
So here I'm just going to rattle off some names, okay? So Google search, dominant platform business for Google. Cash cow, churning off a bunch of cash, right? Then you have Android, YouTube, okay? You have G Suite, so all of the different like Google apps and things like that. Android Automotive, Waymo, Google Home. Now, things that they've tried and have failed: home services, Google Glass. They bought some robot companies and sold those things off. You know, basically, they have 100+ teams that are basically just trying to spin up other platform businesses. If you think about Facebook, okay, Facebook has had the dominant social network. Then they launched Pages, and now they have more of a content platform. Then they launched Facebook Marketplace, right? Then
Messenger.
And then that kind of did okay. And then they bought
Instagram
and WhatsApp. And then along the way, there are multiple other initiatives that they try and start and fail. And that's kind of the model. So what's interesting is that this is the mechanism that they've used to try to be able to outperform time and time again, and to have 10+ year runs where they're able to continue to say, look at the growth that we have. And that to me is very different than saying, I'm going to value Google and the business of search and maybe some of YouTube and Android. But then how do you appropriately price in the growth initiatives? And this is where platforms are in a very special place to do this, because when you have, by definition, a two-sided marketplace or a two-sided ecosystem, you have a huge advantage to then take one or both sides of the existing ecosystem and then use that latent demand or latent supply and channel that to supercharge a new business.
Yep.
And it means that you can either spin out new businesses organically with a much higher rate of success, or you can buy business at multiples that almost no one else can afford. But for you, it's economical because then you can layer in all these other complementary or compounding network effects on top of it.
That's what happened with both Instagram and YouTube, where when Google bought YouTube at the time, people thought, oh, this is crazy. Great acquisition, done very well, worth well above what they paid for it.
And they had Google Video at the time.
Just for inflation. Right. And same with Instagram. It was, $1 billion acquisition. Back then, that was a huge acquisition. And it has done very well for them and has really become one of the huge growth areas, both in terms of users and revenue for Facebook.
And I think that is basically the mechanism as to why growth has been able to outperform value for the past 10 years. And then you have to ask yourself, okay, well, what do the next 10 years entail? Do we think that this cycle is going to repeat itself? And my answer is absolutely yes. There's nothing stopping these companies from continuing to try to spin out additional platform businesses. If anything, they have now hundreds of teams where they might have had 10 teams before. Amazon has literally basically trademarked its process to do this in the 6-page memo, right? Where Jeff Bezos, you're basically delivering a 6-page. I don't know if Jeff still reads every one of these, but he used to read every single 6-page memo. And it was a 6-page memo. It has a certain structure to it. And it basically is saying that you're going to write the press release for the launch of this new platform business. And that press release is going to obviously give an overview of the value prop and all these kinds of things. And it's going to have a bunch of FAQs, frequently asked questions. And then that 6-page memo is basically kind of the platform hypothesis that this team is then going to go out there and try and deliver upon and validate. And Amazon has done this just as well as any of the large tech monopolies. And so then you have to ask yourself, well, what's stopping from Amazon continuing to do this? I guess, do they get too big and they can't focus and, they get sloppy at doing this? I don't think we've seen anything that is indicating their inability to do this or that their size is preventing them from doing this to a lesser degree of effectiveness. And
I mean, we've seen them do it very successfully recently with Amazon Business.
Mm-hmm.
So I think that you're starting to see
Echo and a number of other things that Amazon in the freight and logistics space and all of these things. I mean, it's just so. Then you have to ask yourself, okay, are the large tech monopolies going to continue to outperform? Yes. And then you have to say, okay, well, for platforms in general over the next 5 to 10 years, could more dominant platforms actually start to emulate this new platform business incubation engine? And I also think they're going to be able to do it. Look at Uber. We were just talking about Uber and Uber Eats and Uber Freight.
Okay. Yeah, right.
And then they've got the helicopters and all these and autonomy and all these other things, but you're now starting to see recent IPO businesses expand into adjacent platforms. And now what you're really seeing is this league of platform conglomerate. And I think that's really what I would define this as, is the moment you have a dominant platform business in one area, and now you're able to spin out complementary platforms in similar or adjacent or complementary areas, you get platform conglomerate status. And so Uber is definitely in platform conglomerate status. Lyft is not. That's what we were just talking about a couple episodes ago.
Yep.
What are some other companies that you think are getting into platform conglomerate status?
I think Booking, which we were just talking about earlier, would definitely qualify. They've got a number of different platforms within the different types of accommodations and reservations, as well as Opentable, which we were talking about earlier.
Mm-hmm. I would throw Slack in there.
Yep.
Communication platform. They launched a VC fund a few years ago to spur for other startups to build software on top of Slack and other integrations. And so now they have a dev platform angle going on top of that.
Yeah.
I'd say Bloomberg is a platform conglomerate that not many people are familiar with, right? It started out with a lot of the messaging and kind of social networking on there, but now they also have an app marketplace. They have a data marketplace that you can now put software or additional data into the marketplace and people can buy it. We should actually make a list of all the different platform conglomerates.
Right. Big companies with multiple platform types that they built successfully on top of each other.
Exactly. And I think there's a number in China that we're seeing do this.
Certainly.
And so I think that's the mechanism for where can growth businesses who already are, say, hitting a point of maturity in the core business outperform. It's in their ability to become new platform business incubation engines and to really make the evolution into platform conglomerate status.
Yep.
Which Dara was very familiar with, by the way, at Expedia, transitioning the business into that. They also have multiple platform initiatives going on in Expedia. And so I think that doesn't mean that Lyft won't be able to outperform over the next, say, 5 years, just on its core business. I think it's really at the point where you say Lyft in 5 years, once the ride sharing business is more mature, is a Lyft, are the number 2 platform players in a given vertical, are they able to figure out how they could become platform conglomerate? Because then that's kind of where your growth could slow.
Right.
And you could kind of plateau. You need to be able to fill out that chart and have multiple kind of rising stars.
Yep.
And
you need those growth initiatives,
yes.
those new platform types that are coming up as the current one matures.
Exactly. So we're going to dig into this some more. I think this is an interesting topic. And I think that doesn't mean that all tech companies will naturally outperform. But I think there's a way to look at a certain cohort of them. And certainly just naturally, that's going to gravitate towards the ones that have more of a winner take all market leading position in their given platform vertical. Now, what's interesting is how does a company like Netflix do this? And I think they could, but it's harder.
They don't have an existing two-sided network. It's a very different model to embrace.
Yes.
So there's a mental model shift and a different understanding of what are our strengths as a business, what is our value prop to customers for Netflix that's different than, say, Google.
Yeah. And I would say that would probably be the thing to really give, if platform conglomerates are kind of in a league of their own, what's the thing? Let's go really far out. Not 5 years, but 10 years, 15 years. As this methodology continues, and you have more and more platform conglomerates, what is the macroeconomic shift which could actually try to rival platform conglomerates, or at least make it a more competitive environment outside of just platform conglomerates competing with platform conglomerates?
Right.
And I think that is what is right now a huge vacuum of the large linear enterprises, Netflix included, to figure out how they could be spinning out platforms.
Yep.
And that really, I think, is probably one of the biggest missed opportunities or biggest opportunities in the next 10 or 20 years, is to say, why is it only that platforms, just because, do you have to be a platform to spin out a platform business? And the answer is no.
Right. You still have assets, if I'm a big linear business, that I could use to go spin out a platform company. It's just you have to think about your business, what your core strengths are, how you differentiate in the market in a different way than you typically have done historically. Yes. So there's a shift involved.
In a very different way. I would argue, net, all things kind of kept equal, it's easier if you have a dominant platform to spin out another platform. Okay? It's easier. But it doesn't mean that just because you are a linear enterprise, that you aren't able to also spin out a platform. It just means it's harder.
There's a transformation process there.
That said, I will say that linear enterprises also have a different set of advantages, right? And not all platform opportunities are made the same. So even if you're in the same industry, but you have one platform business and one linear business, and you're competing, let's say in the media industry, right? You actually have different footing. You have a different foundation that you could go after. Doesn't mean that you're all going to go after the same platform opportunity. You have different strengths and weaknesses, but you still have plenty of platform opportunities.
You've seen linear companies trying to compete with these platforms fail is when they basically just try to imitate the scale of the platform without actually embracing the business model, understanding why it is that size, how it got so successful. So you've seen this in media, is why I brought this up, where you have, for example, Verizon that made a bunch of acquisitions in media. Like, oh, we're going to create an ad network that's going to compete with Google and Facebook. Now they're winding that down, selling all the stuff off. They recently sold off, Tumblr? And that strategy didn't work because basically they were saying we're just going to get big. And there was no coherent platform strategy behind how you're actually going to spin out and get some unique content and build network effects and things that actually make these businesses work at such scale successfully.
Use their existing advantages properly to increase their chance of success. So anyway, that's it for us today on Winner Take All. Thanks for joining us.